welcome everybody to our webinar for the morning, How to Never Negotiate Your Way into a Bad Deal Again. Appreciate you being with us this cold Saturday morning. I feel comfortable in saying that no matter where you are in the country, because it's cold everywhere, unless you're in Florida. Let me explain a little bit for those of you who have joined us as guests as opposed to registrants, what's going on here this morning, and then we'll talk a little bit more about it on the back end. This is actually the first class in a series of classes that ends with a 3-day live event on January 16th, 17th, and 18th here in Cincinnati, and it's called the Transactioneering Mastery Program. It's about how to evaluate and negotiate more and better deals. And the folks who are already registered for that class, this is your first class. If you are not registered, this is your last class, although we have 2 more webinars coming up between now and January, and then, of course, the 3-day seminar. So when you hear me telling people to do an assignment and send it through and do things through and so on, I am really speaking to the folks who have already ponied up the small amount of money that it costs to come to that 3-day class and the rest of the webinars. So the rest of you, of course, you're here because I'm getting you hooked. But I think you'll also walk away from today with some really good information that will help you make deals in the future. Now, this is going to be, because this is an actual class, there are going to be some times here where I say, all right, now we're going to stop for a second. I want you to think about this. I want you to write some stuff down. So before we begin here, if you don't already have this, please get a pen and paper. I know you really want to take notes on your computer, but the problem is if you do that, you will have to leave the slide where I am asking you to do something and get a simple calculator. You don't need a financial calculator, just anything that will add, subtract, multiply, and divide, whether that's a physical calculator or the one on your desktop. That way you can fully participate in our class today. So what we're doing today is talking about something that you need to do now before you get into a negotiation with a seller. And it's something that pretty much every person in the real estate business who's successful at making a lot of deals, and particularly a lot of out-of-the-box deals, does. At the same time, I'm guessing that for most of you, no one has ever said that out loud. Like when you talk to people who are successful deal makers, and you say, how do you do it? They never mention this first thing that they did possibly years ago, for the simple reason that it doesn't occur to them to say it because it seems so natural to them. If you are looking to do more deals and better deals and deals that are actually more advantageous to both you and your seller, you need to start this process now. It's not something that's going to take you weeks to do, but it's something that you need to have in writing on paper before you start your next negotiation, because it's going to help you make your next negotiation be a $10,000 deal instead of a $5,000 deal, or a $200 a month cash flow instead of a $100 a month cash flow deal. The other thing that this does for you, and this is going to be particularly important for those of you who are relatively new to the real estate business, is that it's going to take away that scary part of the negotiation that is not about I'm scared to talk to sellers, but is rather about I'm scared that I'm going to make the wrong offer. I'm scared that numbers are going to come out of my mouth and then I'm later going to discover that they were the wrong numbers. If you'll do this and then you'll keep it in front of you, it makes you feel a lot more comfortable that what I'm saying, even if it's not what the seller was expecting or what he wanted to hear, is the right thing to say. And just as importantly, if you're like me, before I did this, man, I would spend ages with every deal I didn't do, especially if it was one that I was close with. You know, we were only a few $1,000s apart, or, you know, only a little bit apart on the terms or something. I would think about that for weeks. I'd say, is there something, could I have done this? Could I have said that? Should I have gone ahead and done what they wanted me to do instead of what I thought was the right thing? I don't do that anymore. When I walk away from a negotiation now without a deal, I'm confident that if I had moved, it would have been a bad deal. And I've also become more and more confident as time has passed that these things roll back around. When you walk away from a negotiation because it doesn't get to where you want it to be, that doesn't mean it's over. If you've done some of the important stuff we're going to talk about in the 3-day class with building rapport and really, you know, getting into the seller's head about what their real source of pain is, you get to the point where you tell a seller, well, I'm really sorry we couldn't get together on this. You hang up the phone and you know you're going to do that deal. You know that sometime in the next few months you're going to do that deal. So the confidence to know that you walked away at the right time. You didn't do it prematurely. It's also the first step in the mastery of this idea of transactioneering, and the idea of transactioneering goes way beyond negotiation. Negotiation is, you want $50,000, I want to pay $50,000, so we'll split the difference at $55,000. That's not transactioneering.
Let me interrupt you a second. Can you adjust your headset or something? We're getting a lot of kind of crackle, and you're kind of coming back and then fading out and coming back. You with me?
Is this better?
It is much better. Thank you.
Okay. I'm holding the phone now, so this is like the equivalent of holding the microphone and the clicker when you're in front of the room. So transactioneering goes beyond the more simple ideas of negotiation and rapport. We are going to cover those, but transactioneering is really about figuring out what works best in the deal, both for you and the seller, even if the seller doesn't know that's best until you explain it to them. And then explaining that to the seller, explaining the benefits of that to the seller, and then being able to document it. So transactioneering is that whole set of things, from figuring out what's there through putting it together and documenting the deal. So for those of you who are in the Transactioneering Mastery Program, this is your first homework assignment. If you're not in the program, you need to plan to hang out an extra 10 minutes at the end today so that you can find out why you need to be in the program. So let's start with an example, and this is where you're going to need to get out your pen and your paper and write some things down, and then you're going to want to start calculating them. We were presented in the past 12 months with two fairly similar deals. One of them is a two-family in an area of Cincinnati called College Hill. This is definitely a rental area. It's a 2 4-room, 1-bedroom apartments, big spacious units. As you can see, it's sort of a newer property for Cincinnati. It was built in the 1970s. And each unit we figured would rent for $550 a month, although they were both vacant at the time at which the seller called us. The after repaired value of this property is roughly $55,000. The repair costs are $7,000. Okay, you got those numbers? The second deal is in an area of Cincinnati called Westwood, and this is West Westwood as opposed to East Westwood. It's a single-family home, 6 rooms, 3 bedrooms, would rent for $900 a month. Actually, the prior renter had paid $900. We figured that it was actually probably more of a $950 a month rental based on the fact that we have one 6 blocks away that rents for $950. this property could also be retailed. If the numbers were right, it's a neighborhood where first-time home buyers do buy properties. After period value, $90,000, and it needed about $25,000 in work to kind of bring it up to the right condition for the neighborhood. So you have those numbers written down because we're moving on. The property in College Hill, the seller owed $47,000. She had a 5.25% loan. Principal, interest, tax, and insurance were $816 a month, and the loan had 8 years remaining. Now, if you're quick enough to do these numbers in your head a little bit, you're probably thinking, wow, that's a really high payment for a $47,000 loan. This was a 15-year loan originally. She had already been making payments on it for 7 years. So the principal and interest payment were pretty high relative to the original loan balance, which I believe was around $65,000, just because it was a 15-year loan instead of a 30-year loan. The property in Westwood, the seller owed $67,000 on at 6% interest. His payments were $735 a month, and he had a 30-year loan and had been paying it for 7 years, so he had 23 years remaining on the loan. So did you get those details? Because the question here is, which deal would you do? And I want to check in with you now and ask you, what are you thinking? When you see these two deals laid out side by side, what is your thought process about how to proceed with this?
Are you actually going to ask them to reply in some way?
Well, I'm getting answers. Linda says she would do College Hill because it goes to 100% cash flow sooner. In other words, there's
the
less,
loan pays off.
Right, there's less time
Mm-hmm.
involved in the loan. Anybody else got an answer? Okay, can't sit here forever, so...
Yeah, I think everyone else is going, man, I didn't expect her to actually call on me.
Mike says it depends on whether I want to keep it or not. Matt says, hands down, the single family. David says the first one has a higher positive cash flow. John says College Hill, it's paid off sooner, and I get 2 renters rather than 1.
Some people see that as a weakness, not a strength.
Well, you can sort of see where their minds are going based on the information. Now some of them do have limits, but their limits are sort of vague. I get 2 tenants rather than 2 renters rather than 1. That is a personal preference, that I would rather have a 2-family than a 1-family, and not, there's no yes or no right or wrong about it, right? As a matter of fact, here's a completely opposite view, which is I want Westwood because it has more flexibility, meaning I could retail it, I could rent it, I could probably lease option it, and of course Matt, who does tons of lease option deals, says I would convert I would convert the multifamily to a single family, lease to own it with no maintenance and no hassle. And I can tell you, knowing Matt, the reason he likes that one better is because it only had $7,000 worth of repairs, and he's thinking, I could get somebody in there who would do that. I'm not sure I could get somebody in one that would do $25,000 worth of repairs. Terry says the Westwood numbers are too tight. Dave says it depends on the exit strategy. What I'm asking is, based on your exit strategy, what would you do? You're probably falling into one of these categories, okay? You either did the numbers by saying, 55 times 0.65 minus repairs is, wow, a whole lot less than what she owes on that property. and did the same thing with Westwood and said, wow, he has a lot more than I can pay for that property. So one thing that you might be thinking is, well, I don't see a deal here either way because I can't pay as little as I would want to, and my strategy involves getting in for cash, maybe it's wholesaling or retailing. You might be thinking, I would do either one of them, but because I need to pay a lot less, the seller would have to cooperate with a short sale. And I can tell you that neither one of these sellers wanted to do a short sale. That was discussed, even though I don't particularly like to do short sales, and neither one of them wanted to do it. You might be saying, well, I do both of them because they have low-rate loans that might be good to take over, and when I do the math, they kind of have approximately equal cash flow, so why not do both? And many of you actually mentioned I would be attracted to one or the other, not so much because of the numbers as because of my personal preference to buy two families, not buy two families, buy in rental areas, not buy in rental areas, whatever the case may be. Now, the thing is, if you were thinking any of those things, you were not thinking from a transactioneering perspective, because you were looking at the numbers and saying, how do the numbers fit together in such a way that I can make a deal? Oh, I don't see that. I don't see how those numbers fit together so that I can make a deal. Instead of thinking like a transactioneer, and what a transactioneer would think about these deals is, what do I need the numbers to be in order for me to be happy? And then how do I go to the seller and present that? Because you're making an assumption, correctly, that most sellers who owe money on a house come to you expecting or hoping that you can pay them enough money to pay off their house. Or that if you were going to take over their loan, which is not something that they're not obviously, thinking, wow, maybe they could take over my loan, but once you explain that that is a possibility, they're thinking, and you're thinking, because they're thinking, how do they take over the whole loan? How do I get somebody to take over the whole loan? So the transactioneering question is not what are the numbers, it's what do I need the numbers to be? And is there some way to get to those numbers by making some deal with the seller other than the obvious one? And that's transactioneering. Now, really, if you had out your calculator and you had out your pen and your paper, you already figured out that on the surface of these deals, neither one of them is really a good deal, kind of no matter how you slice it. If you're more of the wholesaler retailer bent, where you need to get them at a certain cheap cash price because that's how you make your profit, then you did the numbers on College Hill and you said, well, 55,000 times 0.65, or maybe you use 0.6 or 0.7, it doesn't matter. They come out the same way. They come out wrong no matter what you do. That makes $35,750 the value if it were completely fixed up, and it's not. So your MAO, the MAO of your buyer if you're a wholesaler, or you if you care to retail this, is about $28,750, and your wholesale MAO is about $21,750. And if you wrote down all the numbers, you realize that she owes a lot more than that, right? The property in Westwood has a cash or wholesale deal. 90,000 times 0.65 is 58.5. Repair costs are 25. MAO is 33.5. Wholesale MAO is 26.5. Lady in College Hill owes 47. Guy in Westwood owes 67. So what would you do in this case? If you're a negotiator rather than a transactioneer, you probably just wouldn't return the seller's phone call, right? Because you can't see how this deal is going to work for you for cash. On a takeover payments deal, the College Hill property will rent for $1,100 a month. The PITI payment, that's principal, interest, tax, and insurance, is $816. And the maintenance and vacancy, for those of you who said, oh, but it's got some cash flow, remember the cost of owning a rental property is more than just the principal, interest, tax, and insurance. You're going to have vacancy, you're going to have maintenance, you need to put aside money for long-term expenses, right? Because although this roof on this house is probably 8 years old, that means in 12 years it's going to need a new roof, and you better have the money in reserve from your cash flow to put that new roof on. So on a two-family, that number is roughly $330 a month. That's 30% of the gross rent, which means the cash flow is minus $46 a month. On the one in Westwood, the rent's $950 minus $735 PITI minus $190 in vacancy and maintenance, which is, of course, 20% of the rent, because on a single-family home that's fully stabilized, you use a 20% maintenance and vacancy and reserve factor. So that's $25 a month. And some of you are now going, okay, now I want that deal because at least it cash flows. But, of course, the problem is, in order to get it into the condition it needs to be to get it rented, you're going to need to put $25,000 in work into it. So even if you did this deal no money down, it wouldn't be no money down, right? The cash-on-cash return, I'm sorry, the rate of return on putting $25,000 into a property and getting $25 a month out of it, about 1.2%. You can do better than that. So in the year $25,000, I'll double that, at least. So we have this issue here where now it looks like I tried the cash thing and they both owe too much. They don't want to do a short sale. I tried the cash flow thing, and now that I know how to actually calculate cash flow on a rental property, it either negatively cash flows in the case of College Hill, or in the case of Westwood, it cash flows a little bit positively after I do a bunch of work to the property. There are better deals out there, right?
Yeah,
so,
let me ask a question kind of the audience. How many of you, I mean, honestly, how many of you would have gotten this deep into the calculation to begin with? And if you had gotten this deep into the calculation, how many of you would have just been done at this point? Because, you know, it's important in real estate investing to think about the numbers. But what you also have to do is not think just about the numbers, but to think about the deal.
Yes, and I am
confused. So done at this point, would have gotten this far for sure. I would have been done, would have done calculations, would have walked away. I'd stop. Why is vacancy and maintenance so high? Because tenants are barely human. I mean, I assume that's your question. Why is it so high? Because it is what it is. I would have bagged it. So it sounds like the consensus of people who are answering say, you know, they're all through.
Actually, Peggy has it. Peggy's got a good idea, which I'm not going to read aloud because she's going to give away the end here. John says he would get confused, so he'd just be done at this point. And by the way, that is not high. Those 20 and 30% numbers for maintenance, vacancy, and reserves are accurate numbers. And in fact, if you don't fully stabilize your rentals at the beginning, they're higher than that. And if you are a landlord and you don't believe me, I challenge you to go through your books for the last 5 years, because it doesn't happen every month. Like every month you don't put $330,000 into that house. That's not what I'm saying at all. What I'm saying is, you know, every other month while the tenant is there, you might have a $50 repair, or the igniter on the furnace might go out, and you might have to spend $250 on that, but it's irregular. But if you look at it over the long term and include your vacancy costs and include your capital reserves for when the furnace goes out altogether and the roof goes out altogether, it's going to run 20% on a single-family home and 30% on a 2- or 3-family home. I didn't believe it either the first time I heard it. I thought the guy who told me that was crazy, and then I bothered to actually look at my books, and it was if anything, low, because at that time I wasn't in the habit of stabilizing my properties as soon as I bought them. So now you might be thinking something along the lines of, I'll take the second deal, because even though it, only cash flows $25 a month, I will take it because I don't have to qualify and there's no money down. And I would tell you that that would be a mistake. And it's a mistake based on the fact that you haven't done the thing that we're talking about today. You might be thinking, as most of you seem to be, that they're both bad deals, so just never mind. Or if you're a transactioneer, which you will be when you're done with the program, you should be thinking that there is no box. What you should be thinking is, what would the numbers need to be in order to make this deal a good deal for me? What would have to happen in order to make the deal a good deal for me? So here's the big secret. Are you ready? Before you sit down and start trying to negotiate any kind of deal, subject to, seller finance, lease option, land contract, even a cash deal, you have to decide on parameters that work for you. And then you don't get all discombobulated by, well, here's the deal that I am faced with. How can I eke out something here? This is called setting limits. And if you do this, suddenly every conversation you have with a seller becomes a transactioneering conversation where your mind is sort of freed of what are the exact numbers in front of me and do they fit some box that I am used to seeing, and instead be able to say, all right, there is no box. What would have to happen here in order to make it work for me? Now, if you've ever taken like a sales course or a negotiation course outside of real estate, you've probably heard this term setting limits before, but in literally thousands of hours sitting in real estate education classes, I have never heard anybody say, oh, make sure you set your limits. At best, what you get is, well, here's the formula you should use. But it's not always about a formula. There's a lot of moving pieces in a real estate transaction, and a lot of them have to be taken into consideration. So how did this magically come up as a topic today? Everyone who does a lot of deals knows it. But saying it to you, saying, well, now the first thing you need to do is you need to decide what's your minimum acceptable cash flow, what's your minimum acceptable cash profit, what's your minimum acceptable level of neighborhood. To say that to you would be like saying, and don't forget to breathe in and out while you're making the offer. In their heads, it's just something you do. Of course you do it. Why would you not do it? But I've discovered in working with coaching students over the course of many years that it is really not something that most people do or even think to do unless they are one of these natural negotiators. Limits are things that define what you are willing to give up to get what you want. And they are things that you need to decide on now, not when there's a deal on the table. So an example of a limit would be, I know how much time and effort it takes me to sell a wholesale deal. It takes me exactly the same amount of time and effort to sell one where I'm going to make $20,000 as it does to sell one that I'm going to make where I'm going to make $2,000. Now, do I need every wholesale deal to make $20,000? No, because if I set that limit, I'm probably not going to make a whole lot of deals in Cincinnati, Ohio. But am I willing to say there is a point at which I just haven't met the minimum? It's just really, I would be better off going and finding a more profitable deal than working to sell this one that's going to make me almost no money. And the answer is yes, and that is an example of a limit. You are willing to give up the time and energy it takes to sell a deal for some minimum profit, which might be $5,000, or if you live in a higher end market, it might actually be $10,000, $15,000, $20,000. The limits represent a boundary wherein you can confidently say, if I don't get this, I'm not doing the deal. If I don't get this, I can walk away, and I'm not going to feel bad about walking away because I made a logical decision about what my limits were at some point earlier before I had this deal that I'm on the phone trying to make right now. And I can comfortably walk away from that. So the boundary might be, if your limit is, I'm not going to put a wholesale deal under contract unless I know it's going to make me $5,000. Then your boundary would be, at the point at which I have said to the seller in every possible way, this is what I can pay, and he won't or can't do that, then I am going to walk away from the negotiation, of course, leaving the door open that if you change your mind later on, give me a call, and oh, by the way, how about if I call you in a month and see how things are going? They tell you that it's time to walk or time to open up another line of questioning. So when you're a transactioneer, you identify yourself less in regards to your exit strategy. You don't identify yourself as someone who does lease options or someone who does retailing or a wholesaler. You start identifying yourself as someone who finds deals and looks for how they can make money and then does that.
Well, that's a good point. A lot of times when I'm speaking to people, and like maybe potential coaching students of Vina's or just people that we run into, and they say, well, what do you guys do, or what do you do? You're kind of wholesalers. And I say, well, Vina and I are a little unusual, and I describe it as we are real estate generalists. You know, we do, whatever kind of comes along, whatever makes sense. And I know that that's not sort of the most current thinking in the world of real estate investment, that it's all kind of strategy-based and exit strategy-based and exit strategy-driven. I'm a wholesaler, I'm a retailer, I'm a landlord, I'm a whatever. But that's absolutely correct. What I am is a deal maker, or a transactioneer, if you will.
Can you do me a favor and delete all the questions that we've already, or all the comments that we've already dealt with? Because when I go over to this question box, it is full of stuff, and I can't delete and progress the slides at the same time. So yeah, I mean, when you're a transactioneer, what you might say, rather than, okay, the guy won't take a price that's going to make me $5,000, so I'll follow up with him in a month, is you might say, all right, so maybe we should shift over and talk about financing, because if he will finance it, I might keep it for myself, I might rehab it myself, or I might be able to wholesale it with the financing attached to it and get more money. So I can pay a little bit more because I can get a little bit more. So what limits do for you is they give you the confidence when you enter a negotiation that you already know what the minimum you need out of it is. Minimum you need out of it. Now, that doesn't mean you won't make a better deal than what your limits require, but you know the point at which it is time to walk away. One of the funniest things that happens with my fast track students, and I try to grind this under my heel as quickly as possible, is we'll talk about a deal, and I will set their limits for them. And I'll say, don't do it unless she's willing to do such and so. Maybe that's, leave all the appliances. Maybe it's if she'll replace the roof, then you can do the deal. Maybe it's, whatever the situation is. And then the seller says no. And then I get calls for 2 weeks about, well, what if, maybe I should just go do it for the experience. I know that I'm supposed to be making $20,000 off of each retail deal, and I know this one's only going to make 10, but maybe I'll just do it for the experience. Violating your own limits is a really bad idea, particularly when you have taken the time to set them up in advance. And you've done it when you're not in the heat of the negotiation. You've done it based on some logical financial rules, as opposed to, well, gosh, we're only $3,000 apart, so maybe I should just go ahead and do it. The other thing that happened to me when I finally figured out that there were certain limits that I should have on things was it made me get to the point with the seller quicker. The conversation stopped being so long and drawn out and about, and tell me about that deck. How old's that deck? And started being more, get the information, find out what the pain is, figure out where my limits would be for that particular kind of deal, and then just say it to the seller. You all have heard me say I make offers to sellers on the phone. I make soft offers to sellers on the phone. I say I think I'm going to be either here or here, and the only way we can do this deal is if you will finance it. And I don't have to hem and haw about that anymore, or wonder if this is the right thing to say or whatever, because I know what my limits are, and if I know what the numbers are, and I know what the seller's motivation is, I can get to that information pretty quickly and just tell them what I can do and find out if it'll work for them or not. Because there's no reason to drag myself out to look at a property if what I need as a minimum is nowhere near anything that they can do. So let's talk about how you gather these limits. Like what I keep saying, logical numbers. Where do these logical numbers come from? Well, the first place is industry standards. I mean, you all hopefully know what your exit strategy is and understand how that thing works. And as part of that, you've probably been given some sort of a formula. You've been given some sort of a, never pay more than this, or never agree to payments that are more than this, or something like that. And we just have certain industry standards that, you don't offer more than 70% of ARV less repair costs for retail deals. And if you're a retailer, you might even have a second standard if you live in less expensive parts of the country like I do, that says it's 70% of ARV or $20,000, whichever results in the lower offer, right? Because I'm going to make a minimum of $20,000. That's my limit. Some of them are based on personal preference, and you can more and more set this kind of limit the more and more deals you're generating, and the more you get good at what we're talking about today and sort of are able to make more deals. When I first started buying properties back in the late 80s, I didn't care where it was. I mean, I bought a property in mid-Claremont County, it took me an hour and 15 minutes one way to get to that property. But I didn't have enough deals that I could really turn my nose up on what was going to be a lengthy drive. And I had lots of time to drive around because I didn't, have a lot of deals coming to me. So now my personal preference limit for rental properties is it's got to be within a 20-minute drive of my house, and that's in traffic. So you have to be a little bit careful about your personal preference limits until the point at which you have a lot of deals coming at you. And at that point, you can really start picking and choosing and being very picky about zip codes and property types and so on. But an example of a personal preference limit might be, in most neighborhoods, I'm happy with a cash flow of X, but if I'm going to buy one in this neighborhood that I'm not especially fond of, it's got to have a higher cash flow. They're also built into your exit strategy, because the best deal in the world on a rental property in a rental neighborhood means nothing to a retailer. the best deal in the world on a luxury property in a $2 million subdivision means absolutely nothing to you if you're a wholesaler, because you're not going to find a wholesale buyer for that property. So they're partly based on exit strategy, partly based on industry standards, partly based on personal preference. Now, let me give you a couple of warnings about these. We all have ideal standards. That's not the same thing as minimum standards. If you make your ideal standards your limits, you will not do a whole lot of deals. I mean, not if your ideal standards are very high standards. If you decide that living in Cincinnati, Ohio, you're not going to do any wholesale deal that nets you less than $15,000, you'll still do some. But you'll do less than half as many if your limit is 7,500. If you understand what I'm saying. If you said 7,500, you'd do 3 times as many deals as if you said 15,000. So you make more money with a lower limit. I've met people who said, I want to be a wholesaler, but I only want to wholesale in these 3 zip codes that are really close to me. The problem with that, of course, is depending on what's in those zip codes, there just may not be a lot of deals. And even if there is a lot of deals, that means you can only serve buyers who are in those 3 zip codes. I won't buy a rental property unless all the appliances come with it. Really? Like hauling appliances to a property is such a big problem for you that if you could get that property for $2,000 less, you wouldn't just pay somebody to go, just buy the appliances and pay somebody to go get them. So sometimes setting your standards too high, your limits too far out, is just a result of not understanding the market and your options in the market. Sometimes I think it's a way of making sure you never make a deal. Right? If I have these like ideal standards and nobody can ever meet them, then I don't have to worry too much about that part about negotiating or putting stuff under contract or actually closing it or finding financing or anything like that, because I'm never going to do a deal.
And that makes it not scary at all.
Drew has a story that he likes to tell at this point about a guy who killed a deal on an apartment building over a riding mower.
Yeah, there was a fellow that we were working with years ago named Ron, and he was looking to expand into the multifamily game. He was a fairly successful investor. He was a smart guy, and we worked out this deal and worked out this deal and worked out this deal and kind of inched closer and closer to the right deal. And this was, kind of a feat to get that far. This was a listed property that he was getting financing on, owner-seller financing on. So it was just very involved, and it meant several face-to-face meetings, and somehow he got it stuck in his head that he wanted like the 10 or 12-year-old riding mower that was in like the maintenance shed of this apartment building that was used to cut the grass on this thing. And I can see asking for that, right? But as we got to the point where we're actually at a doable price for this whole thing, he was like, he kept trying to include this riding mower, and they'd kept pushing that question off, really. So when we got down to brass tacks, he wanted the riding mower. They ultimately said no, and he was like, this is such a small concession, and we've already come so far. Why not just throw it in? And for whatever reason, they didn't explain their motivations, but they were like, no, that doesn't come with it. And
they were probably thinking, this is such a small concession. Why do you need it so bad?
Exactly. and he was in his own head so much that he wound up melting this deal down over this riding mower that, I don't know what riding mowers cost. But given the age of this thing, I assume its value was measured in the hundreds of dollars. And was a lot younger then, and I didn't have the confidence to just pull Ron aside and smack him in the head a couple times and say, just shut the hell up, about the riding mower. So I just watched in horror as it all fell apart. And it wasn't until kind of months after that, when Ron and I were out, and he kind of sheepishly admitted, I don't know where the hell I was with that. But it was ridiculous, especially frustrating because he really wanted the building, and it was hard to get to the point where that was a workable deal. And it was quite an accomplishment for us to be able to get that far, and then to just blow it over something silly like that because he had somehow gotten mentally inflexible about it.
Well, now he went on to buy some really huge deals in adult congregate living facilities that were in the millions of dollars. But that was the first apartment building he had ever tried to buy. Up until then, he was a single-family home guy. And I think on some level, he had to have not wanted it to work. And apparently he never recognized that level even later when he said, I don't know where I was. I know where he was. He was afraid to buy the building.
That could be. I bet there was some trepidation there.
So another warning about limits, again, set them before you have a deal on the table. Has anybody ever had the experience of finding yourself trying to figure out how to pay the seller his price rather than telling the seller what you could pay? Or trying to give him the terms he wanted instead of the terms he worked. You're like torturing the numbers to try and figure out how to give the seller what he wants instead of how to say to him, I'm sorry, the numbers don't lie. This is where I am, and I'm sorry if it doesn't work for you, but there we are.
Whether you can see it or not, there are 100 people sheepishly nodding on the other end of your computer.
When we do property tours and the wholesaling boot camp, and we're taking people out to see MLS listings, we white out the price. We white out the asking price, because before we started doing that, we would sit there in class and have 20-minute arguments about how they weren't going to take the price that we came up with, or it was a waste of time to make the offer, it was going to make the bank mad, or just people saying, well, but if you could make the roof last another 5 years, then you could actually pay them what they're asking, and that is not the way transactioneers approach these things. So setting them up front means you change your mindset from how do I get the seller what he ideally wants to what's the minimum I can do, and how do I explain that to the seller in a way that makes it a benefit for him. And then, of course, once you set the limits, you don't move them. You don't move them because you really want to make this deal. Matt makes the comment on the question thing that sometimes walking away is the most profitable strategy.
And that's true on two levels. Sometimes walking away is profitable because you don't make a lousy deal. Sometimes walking away is very profitable because then weeks or months down the road, the thing recycles.
Mm-hmm. I got a text yesterday from a guy who has a house in Madisonville that I looked at early in the summer. And where we left it was I could either give him $28,000 cash, or I could give him $32,000 and take over his loan, which basically is going to mean $4,000 down and take over the loan. And I got a text the other day saying, hey, this is Joe. I own the property on Madison Road. Since you saw it, I painted it, fixed the roof.
Hello? You just dropped out, Red.
So he's still motivated.
Wait. Hang on a second. Since you looked at it, he painted it, fixed the roof, and then you dropped out.
Cleaned it up.
Okay.
Because it had $2,000 of hauling to be done. Mm-hmm. And he had a tenant in it now. And the way we ended that last conversation was I said, look, this is what the numbers are telling me. I guess if this just isn't going to work for you, then the thing to do is just hold on to it until you've paid your loan down enough to sell it at this price, or maybe, you know, in 5 years the market's recovered enough that you can sell it at the price you're looking for. But right now, I'd love to give you what you want, but the numbers just do not work. Well, so now he's done $5,000 worth of work to it, and he still wants to sell it at the same price at which he was asking, you know, back when we talked about it in June, and we're getting close now because he wanted 40. I offered 32 takeover payments. Now I can probably offer 37 takeover payments because I can add back in the $5,000 worth of repairs that he's already done. So once you set your limits, trust them. Trust them and say, look, you know, I said that I don't want to do a wholesale deal that's going to net me less than $3,000. So the seller will not get to that price. I'm not going to put it under contract and hope to renegotiate with the seller later. I'm not going to put it under contract and hope there's a sucker out there willing to pay me $2,000 more than it's worth. I'm not going to make myself miserable over did I walk away from $3,000, and I'm certainly not going to say, well, I'm going to go ahead and do this deal at $3,000 because I don't have any other deals on the table. Go spend that time going and getting other deals on the table. So some examples of some limits to set. Now, this is where it gets a little personalized, because this Transactioneering Mastery program is not about the end parts of the deal. It's not about how to get the leads. You should already know that from your other studies. And it's not about what you should do with the properties, because hopefully you've already chosen and learned about a few exit strategies. So different folks on the call probably have different sets of things that they're doing, but some examples would be a minimum wholesale fee, a minimum retail profit, and sometimes that comes in two pieces, right? I either want to make 20% of the gross sale price, or I want to make a minimum dollar figure, and you may have to work some deals both ways depending on where you live in the world. What's the minimum cash flow that you're willing to accept on a rental? What's the minimum cash flow you're willing to accept on a lease option or a land contract deal? What is the minimum equity capture? And this is a place where people who do creative deals, buying with owner financing, buying with subject to, et cetera, make a huge mistake. I don't care if it's no money down. I don't care if the interest rate's spectacular. And I don't care if it's no qualifying. You have to capture some equity when you buy deals creatively. You cannot pay 100% or even 95 or 90% of the value of a property because you got a no money down, no qualifying loan. You will regret that endlessly, and also a big chunk of the profit in those deals is usually when you resell it, right? And if you say, well, it's okay, I'll wait 10 years and then resell it. Well, during that 10 years, you're likely to have, you know, 1 or 2 or 3 different people on lease option in that property, and in between them, you're going to have to maybe paint and clean up. So all your cash flow from your rental profit is going to go back into the house. So there better be some equity there. And what in the world makes you think in 10 years the property is going to be worth a whole lot more than it is right now? You have to capture equity now. What if your lease option tenant buys it 6 months from now? If you got a house that's worth $150 and you sold it for $155 with 5 down, and 6 months from now the tenant goes to get an appraisal, is it going to come in at $150? And would you like to get some more money 6 months from now? Or would you like to get another $5,000, $10,000 6 months from now? So there should be some sort of a minimum equity capture at purchase on these creative deals. Now, sometimes there is more than one factor that would affect whether you would do a deal. Let's talk about, because I only know what my limits are, let's talk about my limits on a subject to deal. Now, we're going to talk about all different kinds of creative deals in the class on January 16th, 17th, and 18th, but since the example we've been using is subject to, that's what we're going to look at. If the property has as little as 15% real equity, it must also have at least $200 a month in actual cash flow. If it has 20% or more in real equity, it has to have at least $150 a month cash flow. So in other words, I'm willing to trade slightly lower cash flow if I'm getting higher equity, which means I'm going to get a bigger back-end payoff. If it has 30% equity, I don't really care that much about the cash flow if I don't have to live with small or negative cash flow for a really long time. So in other words, I would buy a house that had no cash flow or even a small negative cash flow right now, as long as the loan would amortize over 5 years or less. Is this giving you a clue about what to do with these deals at all? Because I'll tell you what deal we actually did, and that was the one in College Hill. And we offered the same deal to the guy in Westwood, and he couldn't do it, okay? So the deal in College Hill, when you have these limits that say, well, I need some combination of cash flow and equity, you can start asking the right questions, which is there cash flow? And the answer is no, even though the loan is only 5.25%, even though it's fixed rate, it loses $46 a month. And then the next question is, can I make it have cash flow? Can I make it have the, zillions of dollars in cash flow I would need to take over that whole $47,000 loan, because that $47,000 loan is basically what the house is worth in the condition it's in right now? And the answer is yeah. The way to make it have real cash flow is to say to the seller, your payment's $816 a month, I will make $600 a month of that payment, and you make the other $216. And that's something that people do. I don't do it because my experience and feeling is that for the first 6 months, the seller thinks that's an awesome deal. I went from paying $816 a month to only paying $216 a month. That's better. After that point, they start thinking to themselves, why am I paying $216 a month on a property I don't even own? I'm getting absolutely nothing out of this. This is a terrible deal. She sucks. I can't believe I let her talk me into this, even though they were happy about it on day one. So I don't trust that kind of deal, and I won't do that kind of deal, because ultimately the seller is going to end up unhappy with it, particularly if it's going to be 8 years or 15 years or 23 years of that before it goes away. So the next question is, does it have 30% in equity? And the answer is no, because it's worth $55,000, it needs $7,000 in work, and she owes $47,000 on it. There's no equity there at all. But the transactioneer asks, can it have real equity? And the answer is, well, yeah, if she would bring a check to the closing, made out to her bank for $20,000. That would get me the 30% equity that I'm looking for. And then I would take over the remaining loan of $27,000. Now, does that create cash flow? It does not. Paying off a big chunk of your loan does not change the monthly payments. What does it change? It changes the term of the loan. So I know I went through that really fast, and I'm going to get a bunch of questions here about, well, how did you come up with those numbers, and how do you write that down on a purchase agreement, and how do you close it, and how do you document it? We will cover all of that in the actual transactioneering class on January 16th, 17th, and 18th. For right now, what I want you to do is I want you to set these limits so that you can look at these deals in this way. If you're registered for the class already, then you have access to Mr. Drew. That was part of the deal for the folks who signed up first, was they have access to Mr. Drew. So set your limits, go ahead and go out and look for deals, and if you get confused about this part up top about the paperwork and how to write up a purchase contract and so on, that's what Drew does for you as part of that coaching. So having these limits allowed me to say this to the seller. I understand that you really want to get rid of this house. I understand that you hate tenants and you don't want to put any tenants in there. I understand that you owe $47,000, and the problem is I can't come anywhere near that price. I mean, let me ask you this. Would you pay $47,000 for this house, knowing what you know now? No, you wouldn't. So unfortunately, the only way that I can see to do this is if I take over part of your loan, and that means you have to pay off the rest of it at the closing. So I would need you to come to the closing with a sizable check made out to your bank, and then let me take over the remaining payments. And I know that's not what you were looking for, and I wish I could do better for you, but you know, the numbers don't lie. It was easy to say that to her because I was confident that that was the right offer. I was confident that there were no circumstances under which I could take over her $47,000 loan. There were no circumstances under which I could pay her $47,000 cash for the properties because I had my limits set up. She did, in fact, bring $20,000 to the closing. We bought the property subject to the remaining loan, which was now $27,000 at 5.25% interest with the same payments. So it still loses $46 a month. Now, does it really lose $46 a month? No, because of the 616 principal and interest payment. A humongous amount of that is principal now. It's as if we accelerated the loan forward by 5 years. In fact, the loan's going to be paid off in about 32 more months, which meets my limit of 30% equity, under 5-year amortization, and small negative cash flow. Would I have done this deal with $250 a month negative cash flow? Probably not. But am I willing to put $46 a month into basically buying more house for 32 months, at which point, of course, the property is free and clear and cash flows $580 a month? When the mortgage payment goes away, all that money that was going to principal interest goes into your pocket. Does the deal make sense to you now? Do you understand why you would want to do it? And the question of why she would want to do it is she already had the property listed. It hadn't sold. It was vacant. She was worried about it getting broken into. She had had a really, 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 really bad experience with her prior tenants. I let her tell me that she was going to do it. I didn't say, here, do this. I said, here's what would have to happen in order for me to do the deal. And she said, does it matter where the $20,000 comes from? And I said, well, I don't want you to rob a bank, but I mean, what do you mean? And she said, well, I mean, I just got vested in my retirement fund and I could take it out of there. And I said, you need to talk to your tax person about that, but I think that's fine. I mean, I don't really care if you have the money in the bank or whether you take it out of your 401k or whatever. So the other piece of this that you need to look at is if this is a rental property, you get to depreciate it, right? You get depreciation on roughly $22,000 worth of purchase price because you got to subtract the land. And the depreciation allowance alone offsets enough of my wholesaling income to more than cover the $46 a month. In other words, the net benefit from the tax benefits is more than $46 a month. So it's an out-of-the-box deal, right? Because it's a transactioneering deal. I'm going to take questions, and then I'm going to give you your assignment, and then for those of you who are not registered for the class, we're going to talk a little bit about the class. So who has a question? Actually, Kent and Narendra got the answer ages ago. Kent says, are the sellers willing to bring money to the table? And Narendra said, ask, can the seller bring money to the closing?
Well, yay them. Excellent.
Yep.
Are
there any other questions?
We had a question early on that I just wanted to hit real quick where Dave asked us to define stabilizing a property.
Oh, making sure that all of the major capital items have at least 10 years of life left in them. So in other words, if the roof is 15 years old, go ahead and replacing it. And
at least
windows,
mathematically, if not literally.
if the windows are bad and you know they're going to need to be replaced, going ahead and doing that. Because otherwise, if you don't pay for it by paying for it, you're going to pay for it in a whole bunch of little repairs and tenants moving out because it's cold in their house, and you pay for it one way or another. So just, get all that stuff taken care of up front. If what I used to do is if the furnace was, 50 years old, but it was still working, I would mentally account for that by saying, well, it's still working. Now we'll have to replace it eventually, but it doesn't have to be replaced right now because it's still working. Except that those 50-year-old furnaces require constant, the blower goes out, the heat exchanger cracks, and it's constant little $200, $400, $600 repairs, where it's better to just bite the bullet and spend $1,800 on a new furnace that's going to last 15 or 20 years. Wow, there are no questions.
Well, we can still clean up a couple things while we're waiting for those. Matt has a great quote. I know you're probably still seeing all the questions because I don't think I can delete the questions on your screen. But Matt has a quote from what he just attributes to a successful investor. We are not in business to practice. When you were talking about, people being wishy-washy about, oh, should I just do this for the experience? And I kind of dig that.
Let's see. Dave says, does transactioneering work with foreclosures or pre-foreclosures and dealing with REO attorneys? If you're asking, does all of this rapport building and putting together numbers and then offering outside the box deals work with banks and their attorneys, the answer is no, not really. You can certainly build rapport with your REO attorneys and with your short sale, your loss mitigation folks at the bank. But my experience with loss mitigation folks at the bank is that you work with one for 6 weeks and then you call back and they don't work there anymore. When we talk about transactioneering, we're really talking about dealing directly with sellers. So does it work in the sense of getting the property under contract with the seller? Yes, but then the real negotiation in a foreclosure or pre-foreclosure usually happens with the bank. In regards to your limits for sub 2, what were your limits on 30% equity? I missed the last part. If it has 30% equity, I will take minimal, zero, or even small negative cash flow as long as it also pays off in less than 5 years. If you can get a copy of the slides, what we will do is post this, and I'm getting repeated requests to show the limits slide. My limits slide?
Yeah, that's what I think people are asking.
All right, so we'll do that. Here we go. This must be the one that people didn't get. Now, my limits may not be your limits. I may be a different, I may be in a different place in terms of my preferences and whatnot, but I can tell you, do not buy a property subject to the existing loan if you're getting less than 15% equity. If you're getting less than 15% equity, do what Matt does, and this is the Matt I keep referring to as Matt Reed. Do what Matt does and do a lease option assignment on it. You don't want to tie yourself to the responsibilities of ownership for less than 15% equity. Let's see. I already answered that one. If we didn't buy the training deal during the OREA conference, are you still offering just the training seminar by itself? Yes, and we'll talk about that as soon as I give everybody who's already signed up their assignment here. Already answered that one. Already answered that one. Already did that. What pushback or counteroffers did the college sales seller make, if any? None. Like everything I asked her to do, she was just like trying to figure out how to do it. It was crazy. Now, part of the reason was there had been a lot of rapport building up to that point because I had offered her. I mean, I could see immediately that the numbers were not going to work the way she wanted them to work. So I said, have you thought about getting a property manager? Have you thought about maybe selling it to a homeowner on land contract? Have you thought about, so I probably gave her 30 or 35 minutes worth of advice before I said, look, I can do this, but you're going to have to bring money to the closing, and if that's not possible or you don't want to do it, I don't want to waste your time going over and looking at the house. And then when I told her what the number was, I said, you know, if it were me, rather than bring $20,000 to the closing, I would suck it up and rent it. And she said, I don't want to do that. I mean, it was crazy how cooperative she was. I remember walking in to the office and saying to Drew, I almost feel bad about this because like whatever, I'm giving her every warning, every piece of advice, every other option she has, and she's just doing whatever I say I can do. And I don't think I could be any clearer that this is not the deal I would do if it were me. But and I assume she gets it.
It was worth it to her to write the check to not deal with the property anymore. You know, she was very upset over how the tenants had treated this property and how much of her time and attention that it had taken, and that last guy, you know, she was appalled that this wasn't that a lease option or something, maybe the last tenant that was in there.
It actually turned out to be a land contract.
Okay, but he
ripped the hell out of her backyard.
And he lied to her. She must have told me that 20 times. You know, she was appalled that he had deliberately, thoughtfully lied to her. And I guess she hadn't lived on Earth up until then. But you know, she didn't want to take a risk of that kind of thing happening again.
Well, and don't get the impression here that this one was stupid. She was like a college professor.
Yeah.
And she didn't. I mean, she understood exactly what she was doing. Let's see. Dave says, "Boy, I'm more famous for that Equity Trust webinar than I am for just being me." He says, you recently did a webinar through Equity Trust where you touched upon creating notes, selling notes, and other strategies. Besides subject to as a strategy, will you be touching upon these and other strategies in your IRA or in your class? We will not be talking, we're talking about real estate in the class. We're not going to be talking about notes. I'm not actually a note expert. I'm somebody who buys notes sometimes. We will, however, for some people, be touching on growing your IRA. I'll get to that in a minute. I'm presently renting a house from a friend. It's a transition house post-divorce. Torn by, can I buy a house from a friend? They are upside down with high payments. They're losing $200 a month on my rent. This is really helpful. I know what I cannot do and what I can do. Good. Excellent. Morning, well spent.
Bravo. Yes.
All right. So if you're already signed up for the Transactioneering class, you have an assignment, which is list out the exit strategies that you plan to be involved in the next 12 months. Your choices would be wholesale, retail, rent, lease option, or sell on land contract. Those would be your 5 choices. And for each of those, set limits in terms of the profit or equity capture, the minimum you're willing to accept, the monthly cash flow, net, not gross, the maximum repairs or repair costs you're willing to deal with. That's a smart limit to set. You know, I can very successfully do a $7,000 rehab. That's like, 2 weeks. I can do a $25,000 rehab. If I got into a $45,000 rehab, it would be disastrous. I don't have the time. I don't have the patience. Because of my exit strategies, that would be $45,000 of somebody's money that sat on the property for a long time. So choose like the most dollar figure, the highest dollar figure worth of work that I'm willing to look at is this, or the highest, or the maximum level of repairs is this, and then your property type and area. I'm looking for 1s, 2s, 3s, apartments. I'm looking for rental areas, move-up areas, bread and butter areas. I want you to actually write these down, and if you are registered for the program, I want you to send them to Drew. If he does not make a comment, it's because they're fine. If they're not fine, he will let you know. If you are not registered for the program and you send them to him, he will delete your email, hopefully before making any kind of snarky remark to you.
Almost certainly not.
So that's drewwhitepics@gmail.com. So what you want to send him is, for my exit strategy of wholesaling, here's my minimum profit. Cash flow, of course, would not apply. Maximum repairs and repair costs probably wouldn't apply because that's really up to your buyer, not you. And then the property types and areas you're going to focus on, or types of areas you're going to focus on. Has everybody who's registered for the class got that written down? Anita says she's missing one of the 5 exit strategies. Wholesale, retail, rent, lease option, or sell with owner financing. Those are your 5 possible exit strategies. Okay, so if you're not registered for the Mastery program, this is your last free class. Imagine what you will be missing out on for the next 3 months, because we have
I thought you were going to go with, if you're not registered, get out your wallet.
2 more. I'm not there to take their wallet. So we've got 2 more webinars between now and the 16th with assignments to get you ready for the class, and then we've got the class on the 16th, 17th, and 18th. Now, what the program is about is deal making. It's about how to comfortably, confidently, correctly negotiate deals and then actually make them. So it's sort of a unique class in that it's not about a single kind of deal or single kind of exit strategy. It's whatever you've chosen as your exit strategy and learned about, that you're going to be able to apply this to that strategy. You're going to learn to get the information that you need from the sellers, because most of you are not getting enough information. You're not getting all of the right information about what is really causing their pain. You're good at getting the address and school system, the rooms and bedrooms, all that kind of stuff, but you're not good at getting the part about what's the goal here, why are you selling, what's really hurting you, what's going to happen if you don't sell, what's your mortgage balance, what's the interest rate, what are the payments, all those things that are really important to really putting together a transactioneering deal. It's going to teach you how to do the numbers and make the right offers. So you're not saying to the seller, well, I could give you $2,000 a month for that, and then finding out later that you can only rent it for $1,900 a month. Getting the evaluation part together. And then, importantly, explaining this stuff to the sellers. You notice I didn't say to the seller in College Hill, well, here's what I want to do. I want to buy your deal subject to the existing loan, because she wouldn't have understood what subject to the existing loan meant. There's a way that you talk to civilians that is completely accurate. It is completely honest, but it doesn't use a bunch of jargon that's going to make them say no just because they don't understand what you just said. Basically, the goal of this program is that whatever leads you are bringing in, you'll make more deals from them. And if you bring in more leads, you'll be able to make a higher percentage of those deals from what is actually coming in. So we're going to show you how to evaluate and negotiate and document. We've got a lot of questions about, are you going to include the forms and paperwork? And the answer is yes. Dave Coffey. The answer is yes. Doesn't do any good to tell you to go put a subject to deal under contract if you don't know what contracts that requires. And we're specifically going to cover...
Have Dave Coffey's remote mind control, apparently, to thank for that.
We're going to cover seller finance deals, so owner financing, which we typically get at 0% interest. over 5 to 10 years. Subject to deals that you're buying on land contract and your cheap cash deal. So to kind of give you, for those of you who weren't at OREA, Drew made a chart to explain which part of this the Transactioneering Mastery program covers. Every course on real estate covers numbers 1 and 6. If you buy a course on wholesaling, it's going to tell you how to get leads, and it's going to tell you how to exercise the exit strategy. If you buy a deal on, or a course on lease option assignments, it's going to tell you how to get the leads, and it's going to tell you how to exercise the exit strategy. We are not focusing on that part. This class is unique in that it covers all of that middle stuff that either isn't really dealt with in a lot of seminars and boot camps, or if it is, it's more glossed over. It's more, and then you negotiate deal, and then and then you go sell it, right? So we're covering the how to get the information, how to build a rapport, evaluate the deal, set your limits, make your offer, and get it all documented and closed. And then whatever you do with it after that is up to you based on your exit strategy. So we'll talk about evaluating and negotiating subject twos, getting no qualifying, no interest under financing, building rapport so that you can make lowball offers without making your seller angry. We will do some live seller negotiations, and it basically fills in all of the blanks that other seminars tend to leave for you. There are 3 web classes. You just attended the first one. The second one is on December 6th, and it's about how to get the information you need from the seller, and this is much more in-depth than here's the questionnaire, just ask these questions. It gets more into the decision tree of, okay, but what if the seller says this? And what if they don't want to give me this information? And how do I react if? On January 3rd, we're going to have a webinar about generating leads to bring to the class, because we need you to bring some leads to the class so that we can do example deals and so on. So that will be our topic on January 3rd. The class is $12.97 for one. It's $15.97 for 2. Now think about that. That's like one deal that you weren't able to do before. One.
Less than one, yeah.
Maybe less than one, depending on what your exit strategy is. So you can bring a true partner, like a spouse, a significant other, a family member, etc., for an additional $300. We have an absolutely 100% satisfaction guarantee that says not, oh, you buy it today and you've got 30 days to figure out if you want to return it, because 30 days from now it's December 15th and you haven't taken the class yet. The return policy is do all the webinars, come to the class 16, 17, 18, and you have until 30 days after the class to come back and say, oh, it's just not what I expected. I don't know. I didn't get anything out of it, which you won't do, which is why we're making the guarantee. You have until February 18th to get all of your money back if you're not happy about it. If you register before December 31st, you will be in the early bird registration period. Our early bird registration is $7.97 for one or $9.97 for 2. So you can save $500 just by doing it now and not waiting until after the first of the year. I know the holidays are coming up. You're going to get distracted. Just, oh, I really want to go to that. And on the 16th, or the 15th, you're going to call Christy and you're going to say, I want to come, and she's going to say it's $12.97. If you sign up before December 31st, it's $7.97 for one, $9.97 for 2. If you are an Inner Circle member or an Express Success member, you can subtract $100 from that. So it'll be $6.97 for one, $8.97 for 2 people. If you're a Fast Track member, please call Christy. I don't even want to say out loud what it is for you guys. It's very, very, very cheap, and it'll just make everybody else jealous. If you register now, and that means before next Tuesday, we're going to be doing a closed-door session on Saturday night. It will be myself and Bob Dressman, and we are going to talk very frankly about how to use these strategies to grow your IRA from a very small one into a very big one in 2 years or less. I know a lot of you saw the Equity Trust webinar. I got a lot of comments about it at OREA, and people have sent me emails. People I don't even know send me emails saying, I want to know how you did this particular deal. And I have to say that that wasn't the whole story. Equity trust has its things that it wants me to say and not say. The story was accurate. Let me just say I didn't give away every secret of how I did those deals. And what we're going to talk about in this Saturday night session is how the deals were actually done and the mechanics of how to do the directions of investment and so on. And if your account isn't with Equity Trust, it still works with every other IRA company in the world as well. I don't know how to say how secret this is without giving away some of the secrets, so I'm not going to.
Well, let me kind of put it this way: we're recording both audio and video this event.
Not this one.
Well, that's my point. The whole 3-day event, we're videoing the whole thing, and those recordings will be available. Blah blah blah. And we use that as a hook to, hey, even if you can't come to the live event, sign up. Just tell us you're not coming, and you'll get the recordings, right? And that's a good deal. If you do not come to the live event, this session will not be included. There's nothing illegal or unethical that's going to be taught at this closed-door session with Vina and Bob Dressman, but it is information that has to be held fairly close to the vest. And
it's very high level, let's put it that way.
Yeah, and we don't want, to give, little children loaded handguns, and this information kind of leaks out and gets disseminated into the, the great unwashed masses.
And people do it wrong, and
and then say, well, I heard from Vina that you could do this. No, so if you're not at this class and they're in person, you're just not going to hear it.
Yeah, and Bob, by the way, for those of you who don't know him, he opened up a Roth IRA like the day they became legal, like 92 or something like that. And let's just say that his IRA is a millionaire, his wife's IRA is a millionaire, his dad's IRA is a millionaire. I mean, this guy has generated so much money through IRAs, and he really, really understands the how-tos in terms of what do you do with the company. So he's somebody you want to meet. So that's if you register before next Tuesday. If you are one of the next 4 people to register, you can still get Mr. Drew's one-on-one help in doing your deal starting right now. Now, we offered this at OREA. 6 people already took it, so we've got 4 left. Here's how this works. You go out and do whatever you're doing to generate leads. You get the information from the seller. You write down what you know. You write down what your limits are for Drew and what your exit strategy is. And then he will structure the deal for you. Now, he will do it in one of 2 ways. The brave way that's going to get you some good experiences, he will tell you what to say. The chicken way, which will get you the deal, is he will get on the phone with you and the seller and negotiate it with you. That is only available to 4 more people. We had a long talk about how, Drew and I had a long talk about how busy Drew is and how many people he thought he could actually deal with and return their calls and talk to sellers and so on. And the answer was 10 total. There are 4 of those spaces left. So the Mastery Program, date's wrong. It's January 16th through 18th in Cincinnati.
You did the same thing in the other slideshow in your summary.
The webinars are today, December 6th and January 3rd. Those are all Saturdays, and they will all be at 10 o'clock. And, yes, they will be recorded. And if you have to miss one, we will send them to you. Also, the class is recorded. And, yes, if you attend, you will also get the recordings of that. It's $797 for 1 or $997 for 2 through the 31st. If you're an Inner Circle or Express Success member, you can knock $100 off of that. If you register between now and the 18th, you get the Closed Door IRA Power Class. If you're one of the next 4 people to register, you get Drew's help in structuring your next deal. Plus, you have the no-risk guarantee. I mean, it's already cheap, and if you don't like it, you pay nothing. You can register at arigatis.com or at 888-ASK-VINA. arigatis.com or 888-ASK-VINA. Now there's questions.
Mm-hmm. Do you want to change that slide real quick?
Change it to what?
You can freeze your screen on the date.
Oh. Oh, I see. You want me to actually make an edit on the fly.
Well, you can freeze your screen, then make an edit, and then unfreeze your screen, so that people don't get the peek behind the curtain of what this actually looks like. Or not, I'm not.
Well, I'm trying. I did freeze the screen. Chill out.
Oh,
Answer some questions or something.
Okay, I will. Let's see. Good. We have.
There's got to be some easy question there that you can answer.
Oh my. Kent says, I will be unavailable to attend the next webinar. Will these be available? Yes. We're recording this one, and we'll make that available. And if you're signed up, or you go ahead and sign up, you will be able to both come to the next live webinar, and you will have access to that recording when it becomes available. We had a question from John about, since you mentioned the Express Success Program and the Fast Trackers, he had a question about that. And John, I just directed you, if you look at the reply, I directed you to Davina's website at arigatas.com and click on the Coaching Mentoring tab, and that brings you to a page that has thumbnail explanations of both those programs, and then links to more information about the costs and benefits of both those programs.
And yes, you can cheat this by joining Express Success and then signing up for the class and saving $100.
Yes.
Go ahead. I'm going to tackle that one last. Are there any recorded sessions available for sale from the OREA conference? Yeah, they're all, except for Mr. Landlord, they're all recorded, and they are available as a package at $3.99 if you did not attend. Have some overlap.
He's confused about the difference between Inner Circle and Express Success.
One's super expensive and includes the other one. That's the difference. For a complete newbie who doesn't know anything about what education should I get to learn the other things to do before and after the transactioneering part? Well, let me direct you to arigatas.com. I have courses in a lot of these things, in wholesaling and lease options, and I can't even remember what all. I can't teach you retailing because I don't know enough about it to give you a really good education in it. What else do we? I don't have a course in rental management. So, I'd recommend somebody like Mr. Landlord for that. But the stuff that I do have is there on arigatas.com. Yeah, the wholesaling course, he says he doesn't see the wholesaling course listed anywhere. That should be back up by the end of the weekend. We took it down because I just completely 100% revised it, and we had like an old picture and old description up there, and it should be back up there by the end of the weekend. All right, that looks like it for the questions. So, to register, unless this is the last class you want, it ain't, because this was, just introductory. arigatas.com or 888-ASK-DINA.
Yeah, hopefully we will see you guys there. This is going to be, I don't want to sound pompous, but this is going to be one of the most valuable classes you ever take in your life, because realistically, no one else is teaching this, certainly not at this level. And I'm not knocking other speakers. Their whole thing is, hey, here's an exit strategy that makes sense. And because I'm a good guy, I'll even throw in how to find these leads. But they don't cover the middle, because that's not what their courses are about. And if they're successful at it, as Vina said, it's because it doesn't even occur to them that someone just coming into the field isn't going to be able to do the middle part, or they don't know how to do it themselves. So this is going to teach you to not be afraid of the leads that you're getting, not be afraid to talk to sellers, because you're going to be confident that you know what to say and how to say it and what you shouldn't say and how to avoid it. that you're not going to accidentally stumble into a bad deal because your mouth just kept running after your brain turned off. And then we're also going to show you how to document all these deals. So you're going to make more money from the leads that you're already getting. You're going to make more deals from the leads that you're already getting, and frankly, you're going to make more money from those deals because you're going to structure them better, and you're going to better benefit the seller because we buy into the win-win concept. So you help the seller more, you make more money, the world, spins along happily, and that's the way these things should work. So
and again, we've got.
Go ahead.
Sorry, we've got literally like a dozen Fast Track students online, and don't sign up online if you're a Fast Track student. Call Christy at 888-ASK-VINA because you've got a super duper special price.
Yep.
I am registered through a business partner. I'm not receiving the emails. Got the webinar through them. How to check registration. Okay, so on Monday, because right now Christy's answering calls from people signing up. On Monday, you can call the office at 888-ASK-VINA, and if we don't have your name and email, she will put it on the distribution list. It may not have gotten. I'm going to assume you got it through OREA, and that they didn't capture your name and email, so we can do that.
Yep, we'll fix
it.
No worries.
Very, very good. Thanks, guys, for joining us this morning. Please take what you've learned today and take it out in the world and use it, or we both wasted our time today. Make sure that you sign up for the Transactioneering class at alreadygotus.com or at 888-ASK-VINA. And for those of you who are registered, we will talk again on December 6th, if not before then. Everybody have a great day.